you're saving for retirement, you're wanting to invest, trying to figure out, hey, what should I be putting my money into? Target date funds, they're a very popular investment for a lot of people. Is that the best path, or should you be doing something different with your portfolio, being a little more customized? Well, that's what we're talking about today on Perfect Game Retirement with Ryan Ledden at Black Oak Asset Management. And Ryan, I like this question because I think target date funds are super popular and they continue to grow in popularity. I guess it's just because it's really easy. They're really easy to use, right?
They're easy to use. A lot of times in retirement plans, if you don't hand pick these selections inside the 401k options, then normally the default fund is based off of the year closest to when you turn 65. So the younger you are, the further those years are going to go out. I think, is it 2070 or 2075 is maybe the most recent target date fund that I've seen. I'm like, oh my gosh, I'll be almost 100 at that age. So anyway, it's an easy way to at least now people are being put in target date funds. I'm not saying it is the right situation for them, right investment for them, but at least it's something that is geared toward their age, and that's really it. Is age and risk. That's the only factors that they're really considering, but it's better than just sitting in cash.
All right. So let's talk then about those target date funds and why maybe, it might not be the first recommendation you get from an advisor to put your money there, and why oftentimes people say, hey, you don't need to put it in there at all. What about target date funds are not going to be beneficial to you versus customizing your portfolio?
Yeah, because it just may not be the right fit. Just because the target date fund is based off of your 65th birthday, which means these are going to get more conservative over time. Well, if that's not your risk tolerance, then maybe a target date fund and you're a young person, maybe you don't have a high risk tolerance. And age is not the only determining factor of that. So you may need to be in a different target date fund or just an entirely different portfolio altogether. But different target date funds, just because it's got the year on there of when you turn closest to age 65, it doesn't mean that's even the right fit for you. Because you can put in a whole bunch of different fund families, whether it's Vanguard, Principal, whoever does target date funds. Pretty much everyone under the sun does target date funds. But you can compare what the risks are for depending on what company produces them. So your risk number may be completely different from a Vanguard fund to Fidelity. So it could be complete, even though they have the same year tacked on the end, 2030, 2035, 2040, it may be completely different from a risk tolerance perspective. So just knowing what you're getting into, I'm not saying they are bad, but I just don't think many people know exactly what the fund does. Not that you need to know every company to a T inside the fund, but you need to know how it functions and what it's going to be doing. And you may look up in 30 years and had the same fund and it's maybe too conservative for you. So just know what you're getting into.
Yeah. And I think that's the tough part about it, right? Is I think it breaks down by the asset allocation, but you don't really know what companies and what specific investments you're actually in, do you?
No, you don't, unless you can do some research on it. And a lot of times websites will maybe show the top 10 holdings or the top 10 percentile holdings inside there. And, if you have a U.S. large group, then it's probably going to be the same groups of companies that we all know inside of there. So some people just not sure what's inside of there. But I will take a step back on target date funds. So again, I'm not poo-pooing. I'm not saying they're wrong or bad, because that's a reoccurring theme, Ben, on this show is it's nothing's good or bad. It's just a fit or not a fit. So target date funds can be a fit for a lot of people, and then they may not be a fit at all. Where I really do like kind of target date funds are when people put money into a plan where they know they're going to need the money. And for example, a 529 plan. I'm all about, like, we kind of know, not without a shadow of a doubt, because some people may not start college at 18, but maybe it's 19, maybe it's 20. But you kind of know when that child is going to go to school, if they go to school. But again, that's a whole nother episode of 529 plans, the options you have if you don't go to school or if you have money left in there. But a 529, I usually tell people you know what, use the age-based one, which is kind of like a target date fund. Even though it doesn't say target date in there, that is essentially what kind of a target date fund is, because you know that 2-year-old is probably going to go to school in 16 years. You're probably going to need the money. So if you get to year 13, 14, 15, you probably don't want to be taking on that much risk, because if there is a pullback, you don't want to have 30% less inside that 529 account when that first tuition payment is due, and you don't have as much time to recover on that. So you probably do want that. The thing with retirement, we have a general idea of when we may retire, but it's more of a moving target than what a 529 is. So again, I think more of a customized approach is better. I mean, if I sat here and told you that everyone should use a target date fund, then the investment management that we do would not be needed at all. So I don't think it's a fit for everybody, but it could be for some. But I think some people may get I'm just going to call it lazy. Some people may get lazy with it and not pay attention to it, because it's kind of a set it and forget it type of investment.
Yeah, it is. And I got in. I was looking at some investments recently in one of my accounts, and just looking at the options that were available. And yeah, it was kind of eye opening to see that target date fund for, I think it was 2070. I was like, man, when I first started doing it, it was like 2040, 2050, right? And you're already in 2070. But to kind of take a devil's advocate approach, if I say, okay, Ryan, I'm not that knowledgeable in investing, but I know I don't want to just take that approach of, okay, I'm going to be at 65. Does it make sense to take that, or to invest in that target date fund 2070, knowing, okay, it's going to be a little bit more aggressive, and I can always scale it back down the road, but at least I know I'm being a little more aggressive than, say, that 20-year-old or 20-year prior fund that's out there as well. Is that approach make sense at all, or is it still like, hey, if you're really going to dial it in, let's just dial it into you specifically?
I mean, it could. It certainly could. It's if you're not sure, because if you look at your fund lineup in your 401k plan, and probably more than, I'm just throwing a number out there, probably 60% of the funds are going to be target date funds. I recently looked at a 401k plan for a client, and the investments in there, and literally they had 4 options, investment option mutual funds that were not target date funds. So, I mean, you may look at that and go, okay, there's nothing there, so I'm just going to put it in a target date fund. So I'm a little biased there. I think you should, as a 401k provider, have more options in there. So when you see that there's only a few options there, yeah, a target date fund may be absolutely the best fund in there. And in that case, that's pretty much what I told the client. Like, hey, you don't have much options here, and the ones you do have, they're just okay. So you know what, the target date fund, let's put it in that. But if you put it in a target date fund, like you said, like a 2070 or whatever, the track record is not going to be there. Not that that's the end all be all of all investing is the past history. It's not, but you're not going to have a very long track record of what is done. And if it's only been the last 2 or 3 years, the returns are going to look astronomically high because the market's done really well. So just know that going in, if you see a 22% rate of return over the last 2 years, that's not really a large sample size there. So don't expect 22 every year.
Well, that's funny you say that, because this one did have a 1-year rate of return. That was the only history it had, and it was at 22%. So
it's like a no-brainer.
Well, look, if somebody comes in and wants to actually sit down and actually customize and doesn't know much about investments, but knows, hey, I want to do more than just have this kind of just general approach to investing, how do you help determine that? What's that? What do the conversations look like to help really dial in where they need to be putting their money?
Yeah, I mean, that's the fun part of my job is, again, when people decide, once we get a lay of the land and people decide to move forward with us and we decide to move forward with them, it's peeling back the layers. Now, I know not everyone wants to get into the details. That's kind of our job, is to get into the details and then tell you, hey, here's the differences between the two. Here's what we think you should do. We do ask our clients their opinion on things, but many, many times they're like, what would you do? That's what they usually come back. What do you think? What would you do? So sometimes I say, hey, if in your situation, here's what I like. Here's what I think you should do. And a lot of times they do that. But I do want feedback from them, because there may be certain things they don't like or don't want to do. And then, okay, that's fine. So let's take that option off the table, or this investment off the table, and let's do this. Just know that you may be giving up this in returns potentially. So We like to call it a co-design plan. Essentially, we're the experts, but it's their money, and we're just there to be that fiduciary on it and help them out along the way.
All right. Well, if you want that help, now's a great time. Just go to speakwithryan.com, get on Ryan's calendar, and begin discussing this question or whatever questions you have about your financial future, your retirement, your goals, what you need to be doing now. All those conversations can begin by going to speakwithryan.com. All the contact information as well is in the show description, so check it out there if you need it. We appreciate you watching another episode of Perfect Game Retirement or listening wherever you are. If you haven't subscribed yet, please do that. We'll have another video coming next week. Talk to you later.